Welcome to Wall Street Confidential. I'm Farnoosh Torabi. We're discussing technology. The sector may seem a little cheap right now.
Right.
We've got AMD reporting, not so great earnings.
This is the roughest sector because when I look at what's going on, I see a lot of momentum buying. Again, it's always going to be the same. It's going to be the steels, it's going to be oil, it's going to be natural gas, and it's going to be ag. Mm-hmm. Now, those because oil's higher, because ag, we read about the rice shortage. There's always a shortage. Then there's this group that people want to say it's cheap and it could have momentum later on, and that's tech. They know that right now business isn't strong, but they want to look through the valley. And that is, other than playing the momentum stocks, bank turnarounds, this is the place, tech, that I think is most dangerous. The others are dangerous because they're up so much that they're having parabolic moves, which historically has not been a good time to come in. But I recognize I've been wrong for the last 24 hours. I love the ag complex, the steel complex. Everybody knows that. This is the complex I dislike more than any other complex, the tech complex, in that I'm willing to buy any dip. Like yesterday, we had a nice dip off of Arch Coal and all the ags. That was a good opportunity.
Right.
But I don't see the opportunity in tech.
Are there any stocks that you like right now?
Yes, I like EMC because, and there's a very good article by James Altucher in Real Money, where he just says, look, VMware has been controlling EMC, even though that shouldn't be. And VMware has now been upgraded by people, and it looks like the worst is over. So I just bought some EMC for ActionAlertsPlus.com. But that's the only one that I really feel good about. And I think that what you're going to have is that maybe you have some weak dollar plays like Hewlett-Packard that people like, but or IBM. But I would be underweighted tech at this point. And so far, I've been right, and I'm not backing away from it.
Jim, are investors wrong to look at history when they're evaluating technology? Because a lot of times these companies are so young or they're still growing in their growth phase.
Well, other than Salesforce.com, I don't see anybody in a real growth phase. And what I look for is cycles, product cycles. And let me take a look at what happened when the Garmin product cycle ran out. And that's still telling a 2x revenue, so I'd still sell Garmin. Corning's got one, and everyone's all jumping up and down about it. And I'd be a seller of it because the stock has moved 5 points into this. We know for a fact that there are, even at RIM, no new product cycles that are attractive enough to make it so that stock didn't go beyond where, it went up to 123 and then stopped. Apple downgrade today. I mean, Apple's a little bit like ag for me. I like to buy Apple in a discount. But the difference here, let me distinguish, ag, oil service, minerals, steels. Those are all things that I want to buy on dips. I do not want to buy tech on dips.
All right. Thanks so much, Jim Cramer. Word of caution on technology here on Wall Street Confidential. Stay tuned for more coverage.